So you're thinking about buying a home. Well, you've got to know that the rule book for how you actually get a mortgage has totally changed. I mean, the old pass-fail test you might have heard about, it's gone, and it's been replaced by a whole new system. Okay, let's jump right in and decode what this all means. It really all boils down to this one simple question, right? It's what every lender on the planet has to figure out, and it's what every homebuyer is probably losing a little sleep over. For years, the answer was based on this super strict, really simple calculation. But now it's a lot more complicated. So here's our game plan. We're going to cover the whole story. We'll start with the basic idea of the stress test. Then we'll look at the old rule, how everything changed, what the new test looks like, and, the most important part, what it all means for you. To understand any of this, we have to start with the single most important number in the world of mortgage lending, your DTI. That stands for debt-to-income ratio. Honestly, it's the bedrock, the foundation for how lenders measure your financial stress level. It's actually a pretty simple idea when you break it down. Lenders take all of your big monthly debt payments, add them up, and then divide that number by your gross monthly income. And that's key, your income before any taxes are taken out. The result is a percentage. And trust me, that one little percentage tells a huge story about your finances. Now, here's a super important detail. What actually gets counted? Lenders are looking at recurring debt. So yep, your car loan, your student loans, the minimum payments on your credit cards, those are all in. And they even add in your estimated new mortgage payment. But your day-to-day living expenses, things like groceries, your electric bill, or even what you're putting into your 401k, lenders don't include those in the calculation. Let's run through a quick example so you can see it in action. Let's say you've got a $300 car payment, $250 for student loans, another $250 for child support, and your new mortgage is going to be about $1,800 a month. Your total monthly debts there add up to $2,600. Now, if your gross monthly income is $6,500, what does that give us? You get a debt-to-income ratio of exactly 40%. That means for every dollar you earn before taxes, 40 cents is already promised to someone else for your debts. This number, this is the key. And for a very long time, there was a really, really hard line drawn in the sand based on it. So how did that hard line actually work? Well, that brings us to the old system, which was all built around this thing called a qualified mortgage. And it was designed to be a super simple pass or fail test. A qualified mortgage, or QM, is basically the industry's gold standard. It's a loan that checks all the right boxes, which makes it safer and more stable for everybody. For lenders, if they give you a QM loan, they get some legal protection because it's assumed that they did their homework and you have the ability to pay it back. And for years, the main gatekeeper to getting one of these gold standard loans was this number, 43%. If your DTI with the new mortgage and everything was 43% or less, you were in. You passed. If it was 44%, you failed. It was literally that black and white. And this quote just nails it. It really gets to the core of the problem. This rigid rule had zero room for nuance. It meant a really responsible borrower, maybe with a high income but a lot of student debt, could be automatically knocked out of the running for being just one little percentage point over the line. You were either in or you were out. And that inflexibility is what made regulators rethink the entire thing. And that's exactly what happened. The Consumer Financial Protection Bureau, you'll hear them called the CFPB, decided it was time to overhaul the system completely. And this isn't ancient history we're talking about. This is a very recent change. The new rule was finalized at the tail end of 2020, and by July of 2021, that strict 43% DTI rule was officially put out to pasture. So, the most important takeaway is this. That hard line in the sand is gone. The mortgage world no longer revolves around that one magic 43% number. So what do they replace it with? Well, instead of focusing only on the borrower's personal debt ratio, the new rule focuses on the price of the loan itself. The test basically shifted from your DTI to the loan's annual percentage rate, or APR, and how that rate stacks up against the market. So this new system created two completely different ways for a loan to earn that special qualified mortgage status. It's not just a single gate you have to get through anymore. Now there are a couple of different paths you can take. The first, and by far the most common path, is what we now call the general qualified mortgage. This is how most loans are going to be judged right from the start. Now, to get this, you need to know two key terms. First is your loan's APR. That's the total cost with all the interest and fees baked in. The second is something called the APR, The best way to think of it is as the market average rate that's being offered to borrowers with the best credit. The new rule is all about comparing the price of your loan, your APR, to that market average, the APR. Here's how it works. For your loan to be considered a general QM, its price, its APR, can't be too much higher than the market average. How much higher depends on how big the loan is, but for most standard home loans, it's around 2.25 percentage points. And here's the absolute key. While there's no longer a hard 43% DTI cap from the government, lenders are still required to calculate, consider, and verify your DTI. It didn't just disappear. And this is so important to understand. Just because the government's hard rule is gone doesn't mean DTI is irrelevant. Oh, not at all. The big players who buy up mortgages, like Fannie Mae, they have their own internal rules. This chart here shows that they still set maximum DTI ratios, and they change based on things like your credit score. So DTI is still very much alive and well. Okay, now for the second path, which is actually really innovative. It's called the seasoned qualified mortgage. This was created to give a second chance to loans that don't quite qualify on day one, allowing them to earn that qualified status over time. This path is basically a performance test. You can get a standard fixed-rate loan, and if you make your payments on time for 3 years straight, that's the seasoning period, and you don't have any major screw-ups, your loan can automatically earn that protected QM status. It's a way of proving you can handle the loan through your actions, not just what's on your application. Okay. So, we've gone through the old rule, the new rule, the two new paths. Let's bring it all home. What does this actually mean for you when you're getting ready to fill out that mortgage application? Even without that hard government rule, lenders still think in these general buckets. If your DTI is below 36%, you're looking really strong. In that 36 to 41% range, you're usually considered to have a manageable amount of debt. But once you start pushing past the mid-40s and especially over 50%, lenders start to see you as a high risk, and it's going to be much harder to get approved. So the bottom line is, managing your DTI is still one of the most powerful things you can do to help yourself. The fastest way to lower it? Pay down your debt, especially those high-interest credit cards. Also, and this is a big one, don't go buy a new car or open a new credit card right before you apply for a home loan. Of course, increasing your income helps, and always check your credit report to make sure there aren't any debts on there that aren't even yours. And that leaves us with one final big question to think about. The shift from a rigid rule focused on the borrower to a more flexible one focused on the loan's price, it was a massive change. Does this new world ultimately offer more protection for you, the borrower, by allowing for more nuance in individual circumstances? Or does it actually protect lenders more by focusing on the loan's price and its performance over time? It's something to chew on as this whole new game continues to play out.